Gold had a very strong week. Gold rose over 5% on the week, about 5.25%. We settled at around $3,358. Silver also didn't have a shabby week, up 4%. Eventually, I expect silver to outshine gold, but still, it's not doing it yet. Silver closed almost at $33.50. So that 100-to-1 ratio is pretty much intact right now. You could buy 100 ounces of silver for 1 ounce of gold. The dollar got beat up pretty bad this week. Dollar index dropped about 2% on the week, settling just above 99. 10-year and 30-year treasuries got clobbered. Yields on the 10-year settled just above 4.5%. And on the 30-year, we settled above 5, I think about 503.
Gold had a strong week, rising over 5% to close around $3,358, while silver also gained 4%, ending near $33.50. Although silver hasn't yet outpaced gold, it's holding steady, keeping the gold-silver ratio near 100-to-1. Meanwhile, the US dollar weakened significantly, with the dollar index dropping about 2% to just above 99. Treasury markets also took a hit. 10-year yields ended slightly above 2%, 4.5%. And 30-year yields topped 5%, reaching as high as 5.15% during the week. Peter Schiff outlines a turbulent week for U.S. markets, with falling stocks, bonds, and the dollar, while gold and silver surged. The 10-year Treasury yield hit 4.62%, and the 30-year exceeded 5%. The decline was driven by two key events: the House passing a massive spending bill, dubbed the Big Beautiful Bill, which increases debt and deficits, and Moody's downgrade of U.S. government debt, following similar moves by other agencies. Fiscal hawks have warned Donald Trump within his party in the U.S. Senate that he must get serious about cutting government spending and reducing the national debt, or else they will block the passage of his signature tax-cutting legislation known as the Big Beautiful Bill. Ron Johnson, the Republican senator from Wisconsin who rose to prominence as a fiscal hardliner with the Tea Party movement, issued the warning to the president on Sunday. Asked by CNN's State of the Union whether his faction had the numbers to halt the bill, he replied, "I think we have enough to stop the process until the president gets serious about spending reduction and reducing the deficit." As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
The high we got intra-week was 5.15, I believe, on the 30-year. The 10-year got to 4.62, I think, before we got, a little bit of buying. But I expect new lows probably by next week in the bond market. Stock market also was down. S&P 500 slipped about 2.5%. So it was pretty much a sell America week. U.S. stocks went down. U.S. bonds went down, the U.S. dollar went down, and gold and silver went up. Now, there were two primary catalysts, I think, for the Sell America trade. One was the House passing the Big Beautiful Bill, which is big, but it ain't beautiful. And because it's so ugly, I think that's one of the reasons that we got the sell-off. And of course, when I did my last market wrap on Friday, I recorded it before Moody's downgraded U.S. government debt one notch. Moody's now being the third credit agency. Standard & Poor's started it years ago, and then Fitch did it, and now Moody's. So all three of the credit agencies have downgraded the U.S. government debt from AAA, but it's still overrated as far as I'm concerned. But that announcement came out after I finished the market wrap. And so I wasn't able to discuss it, but now I can mention it this time. So that's what got the week off on a bad note, right? Because Monday was the first day, or Sunday night actually, was the first time traders had the opportunity to react to the downgrade. But really, it shouldn't be news. I mean, the U.S. government clearly can't repay its debt in any legitimate manner, meaning we can't repay it in dollars that have the same purchasing power as the dollars had when creditors loaned the money. So it's almost like default is inevitable on treasuries. So what's the point in even rating it? The question is, how are you going to lose? Because loss is guaranteed. So you're either going to lose because we default, and the risk of that is there. It's not negligible. There is a risk. It's certainly not risk-free. And so the only mistake that Moody's made, other than waiting too long to downgrade U.S. credit, was they didn't downgrade it enough. But either the U.S. government defaults or it inflates. meaning that either you don't get your money back or you get your money back, but you can't buy much with it because you don't get your purchasing power back. So either way, if you loan money to the US government, you will lose. So really, Moody's wasn't telling anybody something that they shouldn't have already known. But, kind of like, the emperor has new clothes. I mean, somebody says something and then it prompts a reaction. So I think that started the dollar's troubles. But the dollar and the bonds rather too. But the trouble continued as the House passed that big, beautiful bill. Because I think when Donald Trump was initially elected, there was a lot of false optimism out there about fiscal responsibility, about cutting government spending, especially with the introduction of DOGE, the Department of Government Efficiency, really an oxymoron, but head by Elon Musk. And so there was a lot of publicity around all these cuts, and we're going to cut trillions of dollars out of the budget. Now, I never believed this. I was skeptical from the beginning, and I said so on my podcast that I didn't believe that we were going to get all these cuts, that we would get some, but it wouldn't really be enough to move the needle, and that people were making much ado about what would amount to nothing. And when we got this budget, right, the budget dramatically increases the debt. In other words, as a result of the big, beautiful bill, the debts will be higher. The budget deficits every year will be higher than what they would have been without the bill. So the bill doesn't cut anything. Now, yes, there are a lot of Republicans that want to talk about the Medicaid cuts or the SNAP cuts. These are not real cuts. These are phony cuts because they don't take place for another 5 years. That's when they start to kick in. Well, who the hell knows what's going to be here in 5 years? It's going to be a different Congress, going to be a different president. What are the odds that a new Congress and a new president don't repeal those cuts before they ever have a chance to take place? I mean, this is par for the course when it comes to government. They always vote for spending cuts that don't happen until many years into the future. So they don't have to deal with the consequences of the cuts right now. But when it comes to the tax cuts, oh yeah, not only do they happen right now, they're retroactive to the beginning of the year. So the government wants to cut taxes right away, but they don't want to cut spending for another 5 years, which means they don't want to cut spending. Because if they wanted to cut spending, they would cut it right now. They wouldn't wait 5 years. They would just make the cuts start this year. At the worst, next year, 2026, right, January 1st. But the fact that they don't kick in until after Trump is no longer president, right, that tells you that they're phony. But meanwhile, the Democrats are accusing the Republicans of gutting Medicaid when they're not gutting anything. I mean, there's a lot criticized in this bill, but Medicaid cuts is not one of the things that you would criticize.
The speaker, Peter Schiff, discusses a sudden re-escalation of trade tensions. Trade tensions have escalated, with President Trump threatening to impose a 25% tariff on non-US made iPhones and a 50% tariff on European Union goods, effective June 1st. These measures have unsettled financial markets, with investors fearing renewed inflationary pressures and disruptions to global supply chains. Additionally, a 90-day tariff reduction agreement between the US and China aims to ease tensions, but uncertainties remain regarding long-term trade policies. This announcement caused markets to fall and gold prices to rise, reflecting investor anxiety. Peter Schiff argues that Trump misunderstands tariffs and that they hurt Americans by raising costs. He also highlights that the U.S. has no fiscal discipline, with inflation likely to worsen and the Fed eventually being forced to cut rates and return to quantitative easing. If long-term interest rates rise, the cost of servicing the massive U.S. debt will increase, much of which will soon need refinancing. The Fed's efforts to fight inflation have been ineffective because credit never contracted. Inflation continues to rise, and confidence in the dollar is weakening. As a result, the speaker expects precious metals like gold to perform well in the coming weeks. Now, let's shift our attention towards the interview.
We just got re-escalation of the trade war that was just de-escalated, right? Trump agreed to lower the tariffs that he imposed on Chinese goods coming into America, because that was 45%, right? So we dropped those down to 30%, right? And that was a relief, and we got a rally in the market. Gold sold off on that, right? Well, now, early this morning, out of the blue, Trump puts out on Truth Social that, the trade talks aren't going anywhere with Europe. I mean, I thought everybody was lining up to kiss his ass. Now, all of a sudden, we're not getting any progress. And so Trump said, I'm going to propose 50% tariffs on Europe. Now, of course, he doesn't mean on Europe. He means on Americans who want to buy European products, but he never frames it that way. But he said he's going to propose 50%. I mean, propose it to who? I thought he's the one that decides. I mean, is he going to propose it to them? How do you propose 50% to the Europeans? It doesn't make any sense. So I don't know what the language meant by he's going to propose it. He's going to propose it to himself. He's going to propose it to Scott Bessent. Hey, Scott, why don't you negotiate from this perspective? Now, I don't know. Maybe Trump is just trying to manipulate the markets, because the minute he put that post, stocks tanked, crypto tanked, right? All the risk assets went down. Gold immediately went up. Gold was already up before that announcement. Gold was up about $40, and then it was up about 60. I think it closed up closer to $70 on the day, but it was already up 40 even before Trump escalated the trade war with Europe. But he's really not warring against Europe. He's warring against Americans, because all of his cannons are pointed at American citizens, because it's Americans who pay the tariffs. I mean, it's ridiculous that Trump is getting mad at companies like Walmart for raising prices because he raised their costs. I mean, how could they not raise prices? I mean, they have to. They have to pass on the tariffs. That's what tariffs are. They're an indirect tax. They're a tax that the consumer pays indirectly when they buy products that are subject to the tariff, just like a sales tax. I mean, don't companies pass on the sales tax? Of course they do. They add it on right on the top. The companies don't eat the sales tax, so why should they eat the tariffs? It's the same thing. And again, of course, the purpose of a tariff, of a protective tariff, is to reduce the consumption of imports. And the goal is that consumers will buy domestic products instead. Well, what is the mechanism that causes that behavioral change? It's prices. Tariffs make the price of imports go up. And because imports are more expensive, Americans buy fewer imports. They look for domestic alternatives to avoid the tariff. So in order for the tariff to work, the retailer has to raise the prices. If the retailer doesn't raise the prices, then the consumer's not going to stop buying. And so the trade deficits are going to go down. So, I mean, Donald Trump talks about how much he loves the word tariff, right? Oh, tariff is the most beautiful word in the dictionary. It's my favorite word. Maybe because he doesn't even understand it. He doesn't know what tariffs are. He doesn't know what they do. He doesn't know who pays them, right? He thinks it's all external revenue. He thinks it's a way that America can go and pick the pockets of the rest of the world to pay for our government spending. Well, that's not the way it works. But this was a big wake-up call this week to the markets that there is no fiscal discipline in the U.S. Inflation is going to run out of control. It's only a question of time until the Fed caves and not only starts cutting rates, but goes back to quantitative easing. Because I believe if the Fed cuts rates and doesn't go back to QE, the long end is going higher. So instead of a 4.5% 10-year, we have a 5.5% or 6% 10-year. And instead of a 5% 30-year, we have a 6%, 6.5%, 7%. These rates are going much higher. And that's going to weigh heavily on the economy. It's going to make the debt that the big, beautiful bill is already increasing that much bigger, because now all that existing debt and all that new debt has to be financed at an even higher interest rate. Remember, trillions and trillions come due every year of that debt. And most of that debt that was taken on 3 years ago, 5 years ago, 7 years ago, 10 years ago, even then it was borrowed at much lower rates than what exists today. So the costs of servicing the debt keep going up. And if the Fed cut short-term rates and the long-term rates rise, that's going to force the government to keep refinancing at the short end of the curve. And that's going to increasingly shorten the average duration of that national debt. The shorter the duration of the national debt, the bigger the potential problem. Because eventually, when the Fed is really forced to try to put the inflation genie back in the bottle, the alternative being hyperinflation, now the Fed has to go medieval on short-term rates. Well, the government is completely vulnerable because now all that debt starts to mature. When Paul Volcker had 20% interest rates in 1980, 81, yes, it was bad for the new debt, but the existing debt wasn't affected because the national debt was all long-term debt. So it didn't mature into that environment. But when we've got a national debt financed with Treasury bills, and more of that debt is going to be in Treasury bills because of the yield curve steepening, we are in for a world of hurt when the Fed finally has to do something about inflation instead of just pretending to do something, which is all it's done over the past several years. Because for all the talk about tight money, we never got tight money. Gold told you that the Fed was too loose. The whole time the Fed was tightening, gold was rising. If the Fed was really tight, gold would go down. But that never happened. If the Fed was tight, credit would have contracted. Household debt would have come down. Instead, it blew to record highs. If people are borrowing money in record amounts, what does that tell you about credit? It's too easy. Look at government debt. The government deficit's exploded. That doesn't happen in a tight money environment. Tight money is tight credit. Inflation is an expansion of the money supply and credit, because credit is like money. You don't need money to buy stuff if you have credit. And so as people have access to credit, they can bid up prices. So what the Fed has to do to fight inflation is not only shrink the money supply, which is now growing, it's not shrinking, but they have to shrink credit. And even though money supply contracted a bit before it started to re-expand, credit never contracted. Credit expanded the entire time the Fed was pretending to tighten monetary policy. So the whole inflation fight was a lie. The Fed basically surrendered before the fight even started, and inflation won. And now it's going to do a victory dance. But this is what is prompting the exodus from the dollar. And I think the dollar is looking very weak going into next week. It could drop even more precipitously, as this big beautiful bill works its way through the Senate. And who knows, they may even make it worse. I doubt they're going to make it better, but it's hard to imagine it getting any worse. But I wouldn't be surprised, because that is the direction that we're headed in. And maybe this trade war, this renewed European war, will escalate. So I think that next week should be a pretty strong week for precious metals.
Peter presents a dismal image of the American economy, emphasizing growing debt, inefficient monetary policy, and political initiatives threatening fiscal restraint. As a result of the dollar's decline and increasing inflation, investors are looking to gold and silver as safer investments. As trade tensions increase and trust in U.S. leadership declines, the future is still unclear, heightening worries about possible economic instability. Do you think that if the dollar continues to decline and inflation remains high, gold and silver prices will continue to rise? How do you believe that increasing interest rates will affect ordinary Americans in the coming months? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.